All right, today we're going to look at Chapter 9, which are financial projections. And when we mention financial projections, we're looking at some specific things. Learning Objective 1 is looking at how to forecast sales if you have a little bit of history. Learning Objective 2 is the SGR, Sustainable Growth Rate, which answers the question of if you had no additional capital, how fast can you grow without changing the fundamental position of your balance sheet, namely your liquidity, your risk. So what is your maximum growth rate? Learning Objective 3 is looking at the other way. Let's say, no, I don't want to lower my growth rate. What if I know my growth rate and I want to know how much money I need to raise in order to achieve that rate and again maintain my current liquidity and risk profile in my balance sheet. And finally, we're going to do an exercise on forecasting, and we're going to do projections for the main financial statements. So that's today's topics. Very practical finance things. All right, let's look at Learning Objective 1, forecasting sales. As we mentioned in class, it is the hardest and yet the most important assumption. So, we're in trouble. So forecasting sales is an important aspect. And again, it's to show your investors and yourself that you know how to approach the market, how to target, and how to scale up your business in terms of capital and people. So the decisions that we make is everything. We're going to grow sales, and that will drive inventory purchases, staffing levels, overhead levels, and therefore cash requirements. And why is it harder? It's harder because we have so little history, and we don't really have a pattern of retention of business or the success of us selling new accounts. In terms of forecasting, we need to factor the market size, the competition, the price competitiveness, and the aspects of an organized rollout. As we mentioned in class again, do not think of some massive market in a tiny percent. Think of how we can build it from the bottom up. Okay, and in terms of the uncertainty and ambiguity, the way to deal with that is to bracket it. So have an expected case, have a best case, worst case, and then using that information, get to what you think is an expected value, something you learned in your quantitative analysis classes past fall. The top-down, bottom-up approach is top-down is saying what is the worldwide market, then move it down to your potential customers and to an addressable market, which is what you can attack now. Later on, you can broaden your view, but what is your addressable market now? And then what is your target market? What is the profile? Where would you find them? What are their characteristics? And although these are buzzwords, they are important to know, and they're part of the lingo. You may be asked questions like, what is the total addressable market? And you don't want to stare at the sky. Total addressable market is the entire market, everyone globally. Second is the SAM, the serviceable addressable market, which is where can you reach the geographic areas, the segments that you're attacking. And finally, target is the specific. Who are you going to sell and what are their characteristics? And finally, share of market. That is, depending on your measure of the market, what percent market share do you hope to achieve? Bottom up is coming the other way. It's saying, okay, we know who we want to sell, we know our products, our pricing, and we know our competitive advantages. So let's test it and build it up. Based on some primary research, some survey or test marketing, we can estimate what it would take, how we would sell it, and then build it up. And so bottom up is very specific as to targets, and then you build up based on your expansion of either the geographic area or the number of target segments that you will serve. Okay, forecasting sales. The challenges are there regardless of your stage. If you're at the ideation stage, just to make something up, if you had a cloud software company that will manage calendars across multiple platforms like Exchange, Google, or Apple, and put it on all devices like your computers, your tablets, and your smartphones. Let's say there's no prototype yet. It's just an idea. Well, this particular item is the toughest of all because you have very little to go on. So it's going to be very risky and quite subject to change. Second is prototype. Well, you have something like an alternative to soft drinks, and it's a startup, but you don't have sales. But at least you have a prototype. You can do some testing. Talk to people in the channel of distribution, like stores or wholesalers. You can sample it with customers to see the acceptance of the marketplace and hopefully enthusiasm for your product. So you have a little bit more to go on rather than just hypothesizing what the market could and should be. Third, you're launched. Now you have real sales. You have buyers and sellers. You know why people buy, why people don't buy. You know what, if any, competitive reaction you're getting from the incumbents in the business. So you have a little bit more. And finally, you get traction. So here, if we had an example of an industrial product that speeds the processing of boxes, that scans, weighs, does dimensions, and prints the labels without human intervention, this is something that we know works, people love it, and we're ready to bring it to other markets. So each of these we would have different challenges, and you just do what you can based on the information and data and survey results that you have at the time. So if we had a seasoned firm, in other words, a more mature company, a publicly traded company, we would have some history. We would have, in this case, 5 years of history. We can measure the actual growth rates from year over year, and that gives us a little gauge of the trajectory. In this case, the growth rate is a little erratic, 10, 8, 10, 12. So it's growing nicely. It's not super fast and is neither accelerating nor decelerating. So we can then do our best guess using an expected value calculation where we have an average of high growth and slow growth scenario. Here we can use the numbers provided that we had 10% as the average and 12 and 8 as the upper and lower bounds. From that we can do probabilities. Here we can assign 60% probability to kind of the steady state and 20 and 20 on the two extremes. This does not reflect the probabilities that we saw from the prior 4 years. This is our forecasted probabilities that we're even more likely to receive 10% than we had in the last 4 years. And if we do the expected value, 12% growth rate times 20% is 2.4. You sum those components and you get to an expected value of 10% for the firm. The long run view of this is 10%, but you may have some other data that indicates a different scenario based on judgment. So on the bottom right, you see the forecasting for years 14, 15 to 2018. And let's say that you had a 2013 of a plus 12. You think you have no new products coming out in 2014, so you're going to step it back to say 8. In 15, let's say you forecast another new product year, so it boosts back up to the 12, and then thereafter we have a long run rate of 10%. Right? So this shows an example of how you could use some analysis based on history, do some expected value calculations for the long run, and then override it based on your knowledge of what's happening in your product line, your competition, or your internal sales efforts. So if we're at an early stage and we don't have the benefit of that history, what do? Well, we have no data, so we just go to what is your estimation of the most optimistic, the most likely, and the pessimistic, and assign probabilities to those percentage growth rates, and we would do the same expected value. But notice here it's very speculative, right? You're looking at a whiteboard. And so we're using here high growth rates, 60, 50, 40, assigning probabilities of 30, 40, 30, and we end up magically with a 50% growth rate. We then forecast this year's sales of 214 and then grow it at a rate of 50%. So that's a pretty aggressive forecasting rate, it would appear, compared to the prior slide where we looked at a mature company at 10%, but it actually is not aggressive if you have the right product. Early growth companies in high growth businesses that catch fire will double sales per month. Here we're looking at a 50% growth rate year over year, but in high growth businesses you'll see doublings each month or easily doublings each year. So I don't even consider this a particularly aggressive assumption. You just better have a product that works. So then we could scale it down. If we want to be a little more conservative, we change the probabilities so that we're now more likely than before to have a pessimistic outcome. We pare back the pessimistic to a small 10% as opposed to the 40% previously, and we rerun the math, and now we have 36%. So we could do a base case and then judgmentally again step it back to get a more conservative sales assumption. So next learning objective is the SGR, sustainable growth rate, and this is answering a very simple question: how much can I grow if I have no additional funding? Now, This doesn't mean you cannot grow faster. What it means is you can grow faster, but you don't want to change any of your balance sheet relationships. And that means you're not increasing the risk by increasing leverage, and you're not changing any of your productivity of your company. But it's a good baseline to say, okay, if everything were status quo, what percent can I grow at? So the method we see in the textbook has the following formula. Growth rate equals net income divided by net sales. If you look at that, that's for every dollar of sales, what's my net income? So that is a measure of net margin. Second is net sales divided by total assets. If you look at that, for every dollar of assets, how much sales do I get? That is a measure of asset turnover. The third factor, total assets divided by common equity at the beginning of the year. This shows a measure of the growth rate of your assets. And finally, the retention rate. That means out of a dollar of profit, how much do you keep in the business and not give to your shareholders by way of dividend? So those are the factors in the book. And those are correct. I'm not questioning the factors. From another textbook, have found this to be useful, an acronym called PRAT. So if you look at the bottom, PRAT simply rearranges the terms. So we start with the net profit margin, then we go to retention rate, that's the R, then we go to the asset turnover rate, that's A, then we move to the total asset to equity ratio, that's T, so PRAT. So let's apply PRAT to an example. So we have these factors that I just mentioned, but there's no magic. What we look at, if we want to increase the sales growth rate that we forecast without changing our balance sheet relationships, then you could increase your margins. It's always good to increase margins so that for every dollar of sales, you make more money. Second, you can increase R by lowering your dividends, keeping more of the money in the business. Third, you can increase A, asset turnover, which means you can sell more products at the same level of assets and therefore not need as much assets to enable your growth. And T, you can increase your leverage by having more asset growth based on the same level of equity. You could increase your leverage and therefore your growth rate. That one, by the way, would increase your risk, right? But that is certainly a lever you have to push and pull, and that is the level of risk you want to take in terms of your capital structure. So PRAT is a very handy calculation for determining what would happen if you kept everything the same, how fast can you grow. Then as you get more aggressive, know that something's got to give, and so that you could work with factors to see how you would manage a higher growth rate than is indicated by the SGR. The third approach we're going to look at is additional funds needed. You probably have seen this in your finance class, AFN. And the idea is, okay, I need a certain amount of assets to support my sales growth. And then I have a certain amount of assets that will be generated internally. You could finance it internally. And the difference is what you need, right? So first is overall what we need. Next is what will we get naturally. And that leaves what do you need from outside sources. So AFN is outside capital required. Specifically, we're going to look at the assets internally generated because we make profits and that will reduce what we need to raise. And the other is this odd sounding thing called spontaneous generation. Right? Spontaneous means it just happens, right? It doesn't take extraordinary effort to get it. It just happens spontaneously. And what we notice is that in the spontaneous generation, it comes from accounts payable and accrued liabilities. Here's an example that would make it clear. If you buy 100 chairs to sell, and then next year you sell 150 chairs, will your vendor allow you 30 days to pay them last year as they did this year? And the answer is yes. So as you grow, your accounts payable will grow without much fuss, because vendors, if you're paying them as promised, they're going to extend more credit. So some of your growth will happen spontaneously in your liabilities because your vendors will just let you have more money outstanding. So that's what we mean by spontaneous growth. So AFN, let's look at the calculation. Watch out for subscripts, superscripts, and deltas, right? So let's just do it slowly. The first factor, as noted above, is how much do I need in assets? So the first factor is total assets divided by net sales. That says, okay, right now for every dollar of sales, what's the assets I need? So that's a ratio. We multiply that times next year's change in sales, the growth in sales. So you have a growth in sales, and now for every dollar of sales, you need assets. Multiply that ratio times your sales growth, the delta. I'm going to say the delta a lot because there's a big difference between the delta and the absolute. So the delta, or the growth in sales, times that ratio is how much we need in total assets, right? So that's the first box in blue. Next is this idea of spontaneous generation. If we have accounts payable and accrued liabilities, those are kind of natural liabilities you get in your business, and you divide that by the net sales. Now you get, for every dollar of sales, how much do my vendors and other people that supply me debt, how much will they give me? So that's the first ratio, AP plus AL over NS, both for the prior year, your baseline. Again, you multiply that times the delta sales, the change or growth in sales. Now for every dollar of sales growth, how much can we get from our current relationships? That's what this factor is. So this is the second green box, which is spontaneous generation. The final term is how much do we keep in terms of retention. So net sales for next year. Now this is not delta. That's why I keep talking about delta, so I can say when it's not. It is not here. So you take your total sales for next year, forecasted, times your margin, which is based on your base year of times 0, and that estimates how much profit you're going to make next year. And then you multiply it times the retention rate, which is of every dollar you make, how much do you keep in the business as opposed to paying out in dividend. So that last term is the profit I make, or a forecast from next year's sales, times the rate that I keep the money in the business to help me pay for the growth. So those are the factors. So that is the box called assets generate from profits. So the formula below, if you take it slowly, should make sense, and it just relates logically to the colored boxes above. So as an example, if we had sales last year of $1.6 million, assets of $1 million, net income of $160, and current assets of $520, fixed of $480, AP of $48, accrued of $32, and projected next year sales of $2,080,080, right? That's all you need. You only need these 8 numbers in order to calculate the AFN. Below you see the AFN calculation and the terms. So now we do the math. So total assets is $1 million, that's right above. The net sales last year is $1.6 million. The next factor is what is the delta in sales. So next year we expect to sell $2,080 in sales. Last year, our base year is $1.6 million. So we expect to sell $480 more. $480,000 is our delta sales. Next factor, what is the accounts payable and liabilities? We add together the AP of 48 and the accrued liabilities of 32, and that's 80. That's the numerator. The net sales, again for the base year, is $1.6 million. That generates a ratio multiplied times delta sales of 480. We just derived that. And from that we subtract another amount for the amount of money we keep from profits. So we say, what is our sales, not delta, for next year, times the ratio of net income to net sales, which is the net margin, times how much we keep. Here, notice we pay no dividends. So that's a retention rate of 100%. So we do not pay dividends, which is common in growth companies. Most growth companies do not pay cash out because they're needing cash. So retention rates of 100 are common in growth companies. So we work out the math and we get, voila, a number of $68,000. So this is the AFN. In order for us to grow from $1.6 million to $2,080,000, if we keep all the relationships similar, then what we would need to raise in additional debt or equity is $68,000, right? So that's AFN.